with today's drop. The market is now hovering near a 6-week low. Still, our first guest says there are some pockets of upside opportunity emerging for investors. Let's bring in Chris Hyzy, Merrill and Bank of America Private Bank CIO. Chris, it's great to have you here to kind of look into 2023 to the extent that we can. Just surveying the action today, it's very familiar. It's been in some ways the story of the year. Mega cap growth leading to the downside, defensive sectors outperforming. We're shadowed by this recession that people keep anticipating but isn't quite showing up in all the numbers. So are these going to be the themes that carry into next year, or are we going to flip the script a little bit?
Yeah, it seems like this is the final phase, this lengthening phase here where technology is struggling. I should say the growth pockets of the market are struggling. And then there's this realization now that we're headed from an inflation shock to a growth shock in the beginning of next year. And despite the fact that yields are coming down, it just seems like technology can't get that enthusiasm going for tailwinds because the relative growth in their earnings to the broader market is coming in. So there's a little bit more room to go, and it looks like the technology sector is being split into 2 and possibly 3 different types of verticals heading into next year.
And what does that mean for, I guess, the rest of the market? If one were to say, okay, until further notice, tech is not going to be a leadership sector, is the rest of the market in any sense priced for an earnings downturn? Is that what you think the market should be anticipating here?
It looks like this earnings downturn now that everybody is expecting, and they run the math, right? A lot of numerical quantitative analysts will go out there and talk about the decline coming in earnings, but markets generally bottom before the earnings cycle bottoms overall. So the broad part of the market outside of technology still has prospects of earnings declines in it. That's a well-told story. It really is going to depend, Mike, on the actual magnitude of that decline. And I think the broader market, one thing that everyone's talking about is the broader market can't go up if the tech sector doesn't. And I don't think that that's the case. I think when you step back, you look at the big names, you pull them out of the market, it's reasonably priced. We're back to, 15.7, 16 times if you back out the top 5 market cap weighted companies in the broader S&P. And if you include them, they've come down a lot of ways as well. So if the tech sector just levitates on a full 12-month basis, you get a little earnings decline outside of tech, and you look at the broader backdrop, I think you can have a very solid year for the S&P and U.S. equities in general for the full year.
Does that anticipation of a somewhat solid year for the S&P 500, let's say for next year, require that we have the early year gut check? Because I keep commenting that it's really becoming a consensus that we have to have another leg lower in stocks, in growth expectations in the early part of next year. And it just seems as if that's where all the cycle patterns would take you to some degree. People talk about how the market doesn't bottom ever before the start of a recession. So if you think there's a recession, it's too early. So all these conflicting cycle indicators seem to be converging on brace for more downside. But now you wonder, what does it mean that everyone's bracing for more downside?
No, you've nailed it, Mike. This is the essence of the next, say, 3 to 5 months or so. It's going to see confusing mixed data at the economic level, hawkish commentary coming out of central banks, no real change to the geopolitical risk equation that's out there. Earnings likely to get reset by company management first, then analysts next. Rates are coming down. The bond market's telling us we're in a rolling recession, and that lends itself to, okay, what goes next? I think you're right. I don't know if there's a washout per se, but I think the end of the bottoming process, one more go at it, is in the cards earlier in the year. We should have our plans ready right now because a 60-40 portfolio, generally speaking, should be resurrected next year. Savers helped out by higher income levels overall, or higher yield levels overall, and the market giving us that better foundation to leap from early in 23 for the back half of the year.